Talking about the Bank Nifty, the Reserve Bank of India has released its financial stability report. The central bank says that all banks are well capitalized and asset quality issues do not pose any significant threat as things stand. But the RBI remains watchful of inflation, geopolitics, and Governor Shaktikanta Das has flagged risks related to cyber security. Let's get Ritu, my colleague, to give us more on that, and then we'll get some bankers as well to tell us what this means. Ritu.
The short summary is bad loans could reduce and banks have enough buffer to withstand even severe shocks. Now, RBI believes that despite the global economic uncertainty, the Indian economy is well on the path of recovery, even though inflationary pressures and geopolitical risks warrant careful handling and close monitoring of the situation. It finds that both banks and NBFCs have enough capital buffers, with capital adequacy at new highs and bad loans at a 6-year low of 5.9%. But here's the big one that we always watch out for in the FSR reports, and that is the macro stress test. That shows that under the baseline scenario assumed by RBI, bad loans could actually fall from 5.9% in March 2022 to 5.3% by March of next year. And even under a severe stress scenario, gross NPAs could rise to 8.3% for the entire industry. Now, within this, public sector banks could see their bad loans rising to 10.5% by March of next year, from 7.6% currently in the worst case scenario, and private banks could see it touch 5.7%. But again, the baseline scenario is an improvement in these ratios for the banks. Now, capital adequacy overall could worsen, however, to 15% under the baseline scenario and 13.3% further in the severe scenario, with the Tier 1 capital dropping all the way to 10.8%. Now, there's a lot of interesting findings in the report, but I do want to highlight some of these. Particularly, we know the MSME sector was hit hard by the pandemic. The gross NPAs in this segment, however, have come down from about 11.3% in September to 9.3% as of March, but they do remain quite high. The report adds that a lot of MSME loans have also been restructured and they could potentially create stress in this segment. The other interesting takeaway is on consumer credit. Now, RBI says that demand for consumer credit, which was consistently trending upwards since the second wave of the pandemic, has moderated in the first quarter of this year, but delinquencies have stabilized across lender categories, especially for fintechs, where they've almost halved from the peak seen in September at 4.8% to 2.2% as of March 2022.
Okay, thanks a lot, Ritu, for that. Well, let's get two gentlemen now. Sunil Mehta, who's the Chief Executive at the Indian Banks Association, and Kunal Shah, who's been tracking this space very closely from ICICI Securities, joins us now to talk more about that. Gentlemen, thanks a lot for joining in. Mr. Mehta, the RBI's financial stability report, I think the big takeaway for me is that the stress is all set to decline. At least that's what the report indicates. What seems to be the assumption behind this?
So there are 2-3 factors. First major factor is, if you see the trend for the last 6 years, the gross NPA levels have come down substantially on each successive year, and 2022 it has come down to 5.9%. So that's a great improvement in asset quality. Then the second reason is, during AQR of 2016, most of the corporate legacy stress assets were recognized for provisioning. And from 2016 to now, almost all those legacy corporate assets have been fully provided for. That is well reflected into the provision coverage ratio of the entire banking system. In the case of public sector banks, it's more than 80%, and even for the banking sector as a whole, it is more than 70%. So that indicates that the legacy stress asset, which increases credit cost every year because incremental provisioning requirement for aging of those NPAs. So that is now almost over because the legacy stress assets have already been provided for, and the incremental NPA accretion has gone down because the quality of the asset quality, the average banking system has become more transparent, and the information-based lending is happening. Ultimately, the CIBIL and the TRELEC and the other information sources are helping them in taking better decisions. So all these things are contributing into the improvement in the asset quality, besides the support that has been provided in the form of ECLGS to the MSME sector.
Okay, that's great to hear actually, that the asset quality has improved and perhaps the trend will continue to move up over the next many quarters. But Mr. Mehta, the RBI also expects banks can manage with existing capital levels even in the most stressful asset quality situations. But does this also assume that the credit growth will be tepid this year?
No, I think if you see the assumptions of RBI, they are expecting a double-digit growth, and the credit growth, because last 2 years the growth was timid. So this particular year, 2022-23, is we are expecting a growth rate of roughly 10% on more, for the simple reason because base is not that strong, the base is weak. And the second reason is now the economy everywhere, if you find the sectors are bouncing back. You go to the hospitality sector, the occupancy levels are very good. You see the manufacturing sector, the steel has done very well recently. Because of the geopolitical reasons, some setback has come to these sectors. But the infrastructure sector is going to grow because of the great emphasis the PM Gati Yojana and the different infrastructure push which is government going to do will definitely make the demand for credit available.
Okay.
And now the demand, if you see the RBI stability also says the corporate as the service sector both are now going to go for greater offtake of the credit. So the credit growth is not going to be muted; it is going to be in double digit.
Got it. By the way, this is a massive news which is breaking on the screen. There's going to be an export tax on on domestic refiners because of the windfall gains being made. Now, for last many days, for example, I think the most impacted stock actually is Reliance, because for many days we've been talking about the kind of cracks which were there. Prashant, remember the diesel margins which were at all-time high, and I think they had reached what, 25 to $30 per barrel as well. Normally, you see Singapore GRMs at around 10-12, and you add a bit of a premium to that. But over the last few days, the big talk was that will this lead to some kind of big gains? But the big gains are there, but windfall tax is also there. Now, let me tell you that this is not something which Indian government alone is doing. A lot of governments have done this because the gains are huge. I think the diesel crack, if my memory serves me right, had even crossed $30 per barrel. I mean, $70 per barrel.
Yeah.
So obviously there's now going to be a tax on that, and I think that's why it's most on diesel. Now, this does not impact the domestic pump prices. Just to reiterate, this is on exports, because you're exporting in the market, and just to bring that down, this also means that the domestic consumption has to be just to give boost to that, because at the end of the day, this is oil is the most politically sensitive topic. You have excise duty on one side, your pump prices on the one side. You have to find an equilibrium at some point. The government, for example, had cut the excise duty, but even after that, the prices kept going up. And from the oil marketing company's point of view also, you need to think about what you got to do for them as well.
I think you're absolutely right, Anuj. I think the company it affects most is Reliance, because they are the largest exporters. Otherwise you basically have a situation where if you think about what local refiners do, which is MRPL, CPCL, or even others for that matter. The OMCs, which also have refining businesses. They're essentially selling to the local market. We'll have to check what is the proportion of exports, etc. But the fact is that bulk of it, ONGC produces about 20%, 15% of the total energy needs of India. It sells the oil to refiners. Refiners, of course, then sell to the marketing arms, and that's basically what we find at the pump. But this is, of course, affecting exports of products. And that is where the government is basically imposing. And I think, as Anuj said, this is happening in America, where President Biden has been talking about something like this, asking companies to talking about the concept of excess profits or windfall profits, and this is not the time for that, etc. And I think there is an explicit cap, by the way, in a large market like China, that beyond a certain level, companies will not make money. And that has existed there for, I think, about a year and a half, 2 years or so. And I think many other countries are doing it. These are extraordinary times. So we are seeing some of the measures coming in from the government as well. What we should try and do is get an oil analyst or oil company to join us to give us more perspective in terms of how this will work and what the implications could be.
The contribution plate should come up for the Nifty, because this really is the news of the day. Honestly, we should just try to get maybe Prakash can come back. just look at the way the index contribution is. Reliance alone is now dragging the market, the Nifty by 52 points. And if you see the tick by tick of both Nifty and Reliance, that's the reason that you have. Of course, that's one. I mean, just to reiterate, because the gains were humongous. So there's this windfall tax. So we'll wait for some analysts, but till then maybe we can resume our banking discussion.
Oh yes, the Reliance now down almost 3%, right? So we'll get more clarity on that. But in the meantime, we have been speaking to our experts on the financial stability report and the impact on banks. Kunal Shah, the analyst BFSI at ICICI Securities, joins us now as well. Kunal, the big takeaway and what Mr. Mehta was also discussing is that the asset quality has improved substantially for most of the banks, and that's what the FSB report indicates as well. Your own thoughts on how this is going to shape up henceforth? Do you see a further improvement, and on credit growth as well, which could be the biggest beneficiaries?
Yeah, morning, Sonia. So when we look at the financial stability report, in fact, there is affirmation, particularly with respect to the asset quality trend, wherein, in fact, across maybe last two financial stability reports, what was highlighted in terms of the baseline scenario for NPAs, that's been coming up earlier. RBI had highlighted almost 9.8% for March and 8.1% for September 22. And in fact, it is expected to come up from 5.9% in March 22 to 5.3% by March 23. And in fact, even in the medium to severe stress scenario, in fact, none of the SCBs are expected to breach the minimum capital requirement. So what actually requires for them to be lower than the regulatory requirement is the shock of almost 4.7 standard deviation. Okay, so that gives some comfortable picture in terms of the asset quality stress definitely not being the problem for the next fiscal. And as you clearly highlighted, in fact, the report also articulates that even though the global financial stability risks have gone up, but domestic macroeconomic and the financial developments and the financial system, it is strong and resilient, okay, despite the international environment. So to that extent, in fact, we have seen credit growth coming back in the double digits, and banks have adequate capital buffer. And with the improving asset quality trends, I think the confidence in terms of the credit growth improving is definitely higher.
Gentlemen, thanks a lot for joining us and giving us your view. As an update, sources saying that the government has left some gains untaxed on the refiners as well, has gained some windfall gains. We'll try to find out more. Timsey is joining us. She's also picking up some more updates on the moves on gold and